Welcome to the Business with Beers podcast. This is the place where we help entrepreneurs turn their business income into passive income. I am your host, Brian Beers, an entrepreneur on a mission to inspire growth from everyone around me. I'm going to show you how to create generational wealth by growing your business and breaking the chains of Wall Street investing. Remember, you need to take the actions that others won't to live the life that others don't. This week, I've got an amazing show with Catherine Tindall, a CPA who specializes in advanced tax reduction strategies through government credits and proactive planning. And while COVID may be in our rearview mirror, there's still an opportunity for business owners to claim the Employment Retention Tax Credit, or ERTC for short. This credit is for employers affected by shutdowns in 2020 and 2021 who retained their employees. And these credits can be significant. And in this episode, Catherine gets into the qualifications and potential credit amounts. Towards the end, we also get into some strategies on reducing your taxable income by converting active business into passive business activities, and then using passive losses through real estate to offset that income. So tons of great content. Make sure you grab a pen and pencil for some of those parts. We get into some technical things. And if you enjoy this episode, please share it with your friends, rate and review with your favorite part to allow us to reach more people. Hey, well, welcome to the show, Catherine.
Thanks for having me, Brian.
Awesome. So if you could, to start, can you give us a little bit of your journey from maybe 18 years old to kind of where you're at now and how your business and career has developed?
Yeah. So I guess a little bit on my background. I originally wanted to go into medicine because I had a strong desire for my daily work experience to be helping other people. And then as I started to pursue that, I found that it was not going to be the best fit for that desire. So my parents actually had a tax practice when I was growing up. And so obviously being the rebellious kid, I declared that I was never going to go into accounting because it was too boring.
Okay.
But since if you're listening and you already know that I'm a CPA, you can see where that ended up. Yep. So I think my love for accounting started with my first accounting class. And then more specifically, my love for tax kind of came from a combination of really enjoying the problem solving and puzzles element of it. And then the other side of it is, tax is a very expensive and intimidating thing for anybody who has to deal with it, especially business owners, because it's not straightforward. And so I really enjoy the fact that basically half of my time is spent doing puzzles, which I enjoy. And then the other half of the time is really digging into what's going on with people's situations and educating them and really being their advocate. And I find that really personally rewarding. So that's how I kind of got into this career in general. But I always knew even back when I was in college, that I wanted to have my own practice because having control over the relationships and, the model of the firm and those sorts of things, I thought was, that's really important to me. So that's part of how I ended up kind of in this area. So I worked at a couple of bigger CPA firms and then launched this practice coming on about 3 years ago, really specializing in my favorite parts of tax, which is more tax planning and then specialty tax credit work.
Okay. And what's your typical client look like, or the range?
For us, we work mostly with closely held businesses where it's a family or a couple of closely related partners running a company. And then size wise, we kind of started around $1 million and then it's just up from there. I tend to deal with the smaller scale. So, 1 to 20 million. And then my partner in the firm, he kind of does more like the larger scale kind of engagements from there. But that's our typical profile. It's really the businesses is where we focus because our specialty with the tax planning, and that's just where the most opportunity is to really be able to use the knowledge that we have to save people taxes, because that's just where the opportunity is in the tax code.
Yep. Yeah. And taxes for business owners, and a lot of people that listen to this are, business owners or leaders or looking to start their own business. And, taxes are like our single biggest expense. And so, it's a key pillar to learn these strategies. And I mean, honestly, I think it's my duty as a business owner to learn. And I know a lot of people rely on their CPAs, and then they're frustrated because their CPAs and aren't giving them what they think is good advice. But then in reality, most CPAs look retroactively, what happened last year, and then try to figure it out. Most don't look proactively, which are, what's happening in the future and how can I strategically make decisions, buy real estate, do whatever in order to maximize the efficiency. And so I think that's, so I also think it's on the business. It's our responsibility to learn this stuff, learn how it works, and then work. And I'm always the one calling my CPA and asking, hey, can I do this, this, and this? And he'll say like, no, and maybe. And then we'll go in on the maybe, right. To figure out how we can make it work. Cause like you said, it's designed to incentivize people, right? The tax code is designed to, encourage certain behaviors and discourage other behaviors. And it's just a matter of aligning what we do in business to align with what the government wants us to do. So
very true.
So what are some of the biggest strategies that you think people kind of are missing out? Maybe when they come to join you, like what are the 8 first easy wins that are like no brainers? And then what are maybe some of the ones that, maybe your more advanced one is kind of like an aha moment that you work with on the tax strategy and kind of planning arena?
Yeah, well, honestly, I think the biggest, most easy win strategy is being proactive about it. Because a lot of people, they will hire somebody just to do the tax preparation work. And so if you're having to Google things and figure out what you could be eligible for yourself, most likely you're either going to miss out on things or, not know how those things interact. But, once somebody starts getting in that proactive mindset of trying to figure out what can I do? Like, how can I save money? I don't want to spend half of my year just working for the government through paying tax. What can I actually do? Looking prospectively, like that's the first step. But as far as like specific techniques that I think work really well for a lot of people, the first place that I always look is entity selection, because it's one of those things, usually people will set it and forget it. And especially in the current environment where you have incentives to have certain structures over other structures, I think it's, when we had TCJA pass a couple years ago under Trump, that really changed a lot of the, brackets and infrastructure there, so that people who kind of haven't examined their entity structure since then, that's an area for opportunity, because usually once we can move things around, you can kind of stack different techniques. So entity selection is a big one.
And what's on that? Like, can you give an example of something you see? And is it going out of a C Corp into something else, or is it an LLC? Where? Yeah,
it's highly dependent on what the person's situation is, because certain things phase out at different thresholds, how different types of businesses are categorized for the qualified business income deduction. There isn't like a one size fit all answer to that. But I think the one thing I would say with it is it's one of those things you don't want to set it and forget it. And especially if you're experiencing any kind of significant changes like exponential growth or deceleration, or you're looking to transition your business, or you're adding on new income segments in your business, that's the time where it's worth at least a question of reassessing it, because all of those things can impact, what's going to be the most functional. And I'd say the same thing too it really depends on what you have going on personally, because if somebody's got a ton of medical expenses, having your business life structured such a way so that you could potentially make those deductible, that's going to be, different scenarios. And then also, how, if you have a spouse who's involved in the business, or you've got kids who are involved in the business, all of those things can highly impact some of those bigger picture decisions of where you want the thing to go. And then it also really depends too on what your exit strategy is. For somebody where they're pretty much going to be operating out of this entity until they retire, they don't have plans to sell it. They want to transition it to a kid. That's going to be a very different kind of entity analysis than somebody who, okay, I'm going to grow this thing for 5 years and then I want to sell it. So a lot of that, it's a lot of different things that will impact that decision. But I think the main thing is it's a decision that has to be reassessed pretty frequently. Okay.
So being proactive, entity selection, any others that you're seeing as some easy wins?
The other big one that's just like the easiest win is tax credit related work, because those are pretty straightforward engagements. And it's just, for a lot of people, it's a matter of whether or not you're eligible. So some of the stuff we do in the firm, we kind of, half the firm is tax planning. The other half of the firm is specialty tax credit work, just because we started seeing a need for it more and more. So my other partner in the firm, he does research and development tax credits. And so a lot of companies just don't even realize that they're eligible for it because you don't have to be like a science lab developing, new products in order to be considered scientific enough to get those credits. And then the other one we've been seeing a lot more of is the employee retention credit, which is basically a COVID related credit for employers.
So on the R&D, can you give an example of one that you've successfully gotten, like a type of company that maybe thought they wouldn't qualify or industry?
Yeah, it's, a lot of people who are doing like software work or computer work can qualify for it. A lot of companies that are doing light manufacturing, where it's not even that they're developing a product, but that they're developing the process of how they create certain products or certain manufacturing processes. The technical specifications of how you can get it. I like to tell people, if you're doing something where you're basically having to spend money to perfect a process, that could very likely qualify for R&D. So it's at least worth a conversation with somebody who does that kind of work.
Does knowledge work qualify, or did you have to like produce something?
No, knowledge work can qualify as well. Certain things like arts. So if you're doing like, historical research or creating artwork or something like that, wouldn't qualify. But if you're developing, intellectual property or other things like that, it just depends. It really depends on the facts and circumstances. But I'd say it's better to reach out to somebody and be told no, than to just, try to Google it and be like, oh no, I don't qualify, and then not pursue it. Because some of those credits, depending on how much money you're spending on those activities, they can be pretty significant. Usually for people where we see it's, at least a 5 or 6 figure tax credit. And very often people continue to do the same kind of research activities every year. And so they'll get those credits every year. Like one we had recently was like a brewery, so they're constantly developing different beer styles, different,
that counts.
Yeast and stuff like that. And it's research and development, and they very easily qualify. So
that's awesome. And it's like a core part of the business. Like they're going to do it either way.
Oh yeah. No, they're always doing new formulations of things. And so that qualifies,
Awesome. Yeah. So let's get into the other big one, the ERTC. First of all, what's that stand for? And like, how do you qualify? Let's get into that.
Yeah. So it's called the Employee Retention Tax Credit. It is a tax credit that Congress issued for just related to the pandemic. So it's for tax years 2020 and 2021. It's for employers who maintained payrolls during the pandemic. There's a couple of different ways you can qualify for it. But I think the main thing to take away with it is it can be a very potentially valuable tax credit. It caps out to $10,000 per employee per quarter. So you can imagine if you have 10 employees where they're meeting the cap, for one quarter, if you qualify, that's up to $100,000 of tax credit. So it's well worth for one quarter. Yeah. So and you can qualify for up to 8 quarters. So it's, potentially a very, we've seen a lot of smaller companies qualify for 6-figure tax credits on it, because all you have to do is qualify under, there's a couple different ways to qualify for it. And then, it's a pretty straightforward, there's a lot of interactions in the calculation, but it's very worthwhile to pursue it. And I'd say, basically, if you're an employer that had employees during the pandemic, it's worth at least a conversation with a tax professional about, because more often than not, I've seen people who thought they weren't eligible for it be eligible for it. So.
Okay. And what are some of the baseline ways to qualify for it?
Yeah. So there's a couple of different ways. The first way that's the easiest to demonstrate in a lot of ways is if you had government shutdown orders. So if you had in the state that you're operating out of, there were restrictions on either the ability to operate or, capacity restrictions. So like for restaurants or hospitality, they were limited to seating, how many, seats they could have occupied, or things like a lot of companies, if you weren't deemed an essential business and were forced to close or things like that, those are ways that you can qualify. But barring that, the other mechanism by which you can qualify is by having a certain percentage of quarter over quarter revenue drops. And so there's a couple of little weird techniques where you can get quarters to be eligible with like look back periods and things like that. And so I would just say it's worth it to just consult a tax professional directly, because it's not a straightforward eligibility calculation. And I've seen people even go to their CPA and their CPA told them that they weren't eligible without actually, requesting the proper, like really crunching the numbers on it, because it really just does.
Yeah, because there's so many different ways.
Yeah, there's a lot of variables with it. Some
override the others. Like I think, you could be essential business. You stayed open, but you had a sales decrease, then you qualify, right? But I guess what happens though if, like, so for us, we were an essential business auto repair, but some of our, like in Philadelphia, there were some capacity restrictions. Now, does that do they battle each other, like, or is if you check one of the boxes, and a lot of times you're good? Yeah,
if you check one box, you're in. So it's a matter, how we do it is we start off with the easiest way to qualify people, which is the government restriction orders. And then if you don't qualify under that, then we look at, okay, what's going on with the financial data to see if you can qualify under those standards. And there's a lot of like little moving pieces with the calculation. So that's kind of the simplistic version of it. But I would say for anybody who has employees, definitely consult a tax professional about it. And I would, really insist that they look at your actual financial data, because I've had people come to me where they went to their CPA, were brushed off. And then when I asked for the specific, it's a quarter by quarter calculation. So when I said, did they even look at your quarterly profit and loss statements? And they said, no. I said, well, that's what I need to see, because that's how you do that calculation. So if you have a tax professional who isn't even looking at that, I would talk to somebody else. But the main issue with that too, that I've seen happen a couple of times, is people can be year over year more profitable, but because of, supply chain issues, they had revenue discrepancies on when they got paid out on jobs. So I had one a couple of weeks ago that was an engineering firm, and their permit office was really backed up for like their permit office shut at the beginning of the pandemic. So it really delayed out when they got paid on their jobs. And so even though they were more profitable year over year, they still qualified because of the timing discrepancies. So it's one of those things where you just really want to have somebody assess your specific situation.
Okay. And how long do we have until to submit these claims? Is the end of the 2022, or what's the deadline?
Yeah. So because it's a tax credit claim, I think a lot of people are getting confused with, the payroll protection program was a limited time window and a limited funds window. This credit doesn't operate like that. It's just a standard tax credit. So we basically have until the IRS audit window closes. So that's, 3 years for claims in 2020, it's 3 years out from there. For claims in 2021, it's 3 years out from there. Oh, wow. So we've got, there's time.
A while. Okay. Yeah. So you submit this form, and then how do you get paid? How do you get paid back? Is it credit somewhere else? Do they send you a check?
So basically how it works is it's a refund of payroll taxes. And so the mechanism by which you claim it is by filing an amended payroll tax return. You file that amended payroll tax return, the IRS processes it, they send you a check in the mail. Okay. Right now we're seeing some really significant delays in when people are getting the actual processing and checks back. The IRS, I think, currently has almost 500,000 unprocessed claims.
Okay. So it could take like a year to get the money.
Yeah, it could.
Something like that. Okay. But it sounds like, for some, it could be several $100,000. It could be a significant amount of money.
Yeah. I've seen ones that are over $500,000. Like it can be very, depending on how impacted your business was and how many employees you have, because it really comes down to the employee head count. That's how the calculation, that's the main thing driving that. It can, it's well worth the wait. Something that we're working on in the practice that's still in development is working with outside financing companies to advance on the credit payments. So that's something that we're in development of, because I find it appalling that it takes a year for people to get refunded their money.
Yeah.
But it's just, and the IRS hasn't had a budget increase for however, it's a mess over there.
So are you doing that now, these advances on it? Or
it's something we're developing.
Okay.
Yeah.
Yeah, it's kind of what H&R Block does, right, on a massive scale. If they can advance people the money, and then it gets paid back to them for with interest.
And these are really large claims, so it's it's a more intensive process than, say, getting an advance claim on like $3,000. Some of these, it's like they can be, $500,000 to $1 million claims, depending on the scale of the number of employees involved.
Okay. That's awesome. Well, yeah, I definitely got to look, we looked into it before, and, I'm probably going to look into it again after this, just to double check, because it definitely seems like a great opportunity.
Yeah.
Hey, so another kind of pivot here is, so for business owners who make most of their money through active resources, what are some ways that they can then start to shift the money to more of the passive buckets? Because passive income isn't taxed as much as active income. And so any ideas on some strategies? I have some of my own. I just want to hear some of your opinion on it, of to lower the taxes on it.
Yeah, it really depends on how you're doing that strategy. Often I see where people do the pivot is getting into real estate investing. Yep. Just because you're able to basically, if you can game it right, you can take paper losses against real income. And so you're generating a positive cash flow without triggering a bunch of tax. So that's usually the scenario I see people go into. But as far as the pure, transitioning income from being active to passive, there really isn't a tax benefit on that side, other than, some little maneuvers you can do with self-employed tax. But for the most part, people who are actively earning their income, you've kind of already achieved that self-employed income tax savings, before you get to the putting things into the passive bucket.
So through real estate,
it's really around the real estate.
Yeah. So that's what we do. And that's what, I think a lot of the listeners do as well. So we invest through, buying buildings directly or investing into syndications. Right. Yep. But then a lot of times, people say that, well, the syndication depreciations can offset, income that you earn actively, but that's not true though. Right. Cause aren't the buckets, there's separate buckets, right? Active bucket, passive bucket, and and it's contained within the bucket. So then you have to find ways to then increase the income on the passive side. And so I know a number of people go through the real estate professional status, right? Yep. So I guess, can you talk a little bit about that and tell me, like, how can someone qualify in some of the risks? Cause I know that it is a more scrutinized, for the reason that it's very advantageous, because you can, buy real estate and then offset your money. So can you talk a little bit about how the real estate professional status works, how someone qualifies, and then, we can kind of get in from there?
Yeah. So basically the real estate professional status, it's a common one that we kind of help people go through, because it, like you said, it's a really high area of interest for the IRS. The rules are very picky. It's very easy to disqualify yourself from it. And oftentimes I'll have people where, we might intentionally want to disqualify them from it. It really depends on their situation. Sometimes the easier mechanism is to just turn your main income into passive income. And that's the easiest way to get to that. Because if you can reduce your level of participation in your main operation such that you can qualify it as passive income, that's one way to offset those. And I know it notes it as material participation, right? So if I'm active, I'm a cog in the machine, right? Then I'm active. So for me, I run the business. We have, 200 employees. I'm the president of the company. Yeah. So I have to then remove myself from day to day and act more as like the board member for long-term vision. Does that get me there? Or like, what do they have to stop doing to not be material anymore? Mm-hmm. Yeah, it's an hours test.
Okay.
Yeah, there's a couple of different ways you can fail it, but the easiest way to really conclusively prove it is an hours test. And so they have a set limit of how many hours you can participate.
500?
I think it's 500. Yeah. But so you have to be, you can either, if you can pull yourself out of it enough that you're not doing materially participating, which is a bunch of different rules around it. That's one way to get that treated as passive. The other option you can do too is try to break out things, right? So if you're materially participating in one piece of a business, but not really another piece, if you break those out into separate entities, now you can have this other entity, which is passive income to you. And that's a way that you can bucket that over to offset with the real estate. So, there's a couple different ways to get there. It just depends on what your goal is. For a lot of people with the real estate professional status, if you don't want to make real estate your life, it's usually not a good way to go. Yep. A lot of times the easiest thing that we can do to get to that, is if you have a spouse who's really interested in real estate and they want to get their license, they want to sell some homes or something like that. And then you've got all these other holdings, that can be a way to get to it efficiently and easily, but it's one of those things where you really want somebody to look at your particular situation and then also have a good idea of what your goals are for like the next 5 to 10 years, as far as how you want a portfolio, how you're earning your income. Because it just really is dependent on that. Because I wouldn't, I have people where, rep status would be awesome for them. But they don't want to be the one that's having to manage all these properties. They don't want to, have to shovel a driveway or reconcile a bank statement or do anything like that. They just don't want to have that level of participation. And so we just find other ways around, how can we try to offset this income against each other, given, the kind of lifestyle that you want to have.
Okay. And then, so on the syndication side, so I invest a lot in syndications and, we get the depreciation write-offs, but so even though if my wife became a real estate professional, would the syndication would that still qualify to offset it? Or is that still considered passive because she's not actively participating? Neither of us are participating on the syndication side versus a rental property that you're shoveling the driveway or whatever.
Yeah. So on the syndications, I think you would still be considered passive, but it's one of those situations, like it depends how everything's being held. Yep. And I'd say for the most part, it's, if you're really trying to like run those projections and those numbers yourself, it's probably worthwhile to engage somebody to do what we call a technical memo, where they actually just look at, okay, here's what you've got. Here's how things are held. If you behave this way, this is how it's going to like pan out on the tax side, versus if you behave that way, this is what the effect will be.
Yeah, but that's great, actionable advice, especially for people who own multiple entities and multiple businesses. If there's a material role that they can, officially move into, then they invest in syndications, right? The passive income, they have passive losses. Now they're not paying tax on either one of the activities, and it's all, totally legit. But so that's what it's about.
And it's about gaming it.
Yep. And being proactive.
And I think people, it's really the mindset of, okay, here are the pieces we have to play with. How do we game this? The law is pretty clear. It's just a matter of arbitraging on the tax law. Yep.
Okay. And is that the biggest, those are the biggest ones you see, kind of the material role and then rep status? Are there any others to game it?
On the active income, passive income. Yep. Yeah. I think a lot of people, they get really wound up with, tax planning as retirement planning. I'm not really a big fan of that piece. Things that defer tax, you're just putting a question mark on it. So as far as like actively just wiping out tax, those tend to be really good strategies. And then if you can take advantage of like the tax credits and just knowing kind of what's out there, those are because that tax credit's a straight refund back, and that's taxable income though, isn't it? Yeah, so that's part of what happens is if you do get a tax credit, you don't get to double dip, so you do have to pay income tax on the tax credit. But for most people, if they're in a pass-through entity that's organized efficiently, you're probably going to get like a 20 to 25% haircut on that. So that's part of the complications with some of these calculations and claims, is that it's not as simple as like, oh, I get 10 grand per head per employee. There's a lot of moving pieces and things that interact with each other. Yep. It's awesome. Hey, on a pivot, we all have 168 hours in a week. And so what are you doing to kind of grow your business, scale your business in order to, maximize the efficiency and grow your practice? Yeah, I think for me, my biggest fan is technology in the firm. So we've really spent a lot of time investing into developing out automations around things. So like the work that we do with some of the tax credit work, we have a lot of automations in place for how those get calculated and reviewed and those kinds of mechanisms. So I think in an industry like mine, where it's really difficult to find qualified people to do work, the more you can lean and leverage technology is extremely helpful. So that's something that we've done that really buys back a lot of time, and being really intentional around, how we're doing things. And then also, I think the other piece that's really helped us scale and leverage is I'm a big fan of just be good at a couple of be really, really good at a couple of things and not say yes to everything. And I think that's been a really good methodology for my practice. So we do a couple of things and do them really well, and then have a lot of automations and systems in place so that we can produce the results that we want, and that we're not, one of the principles I have in the firm is nobody works overtime. If people are starting to have to work overtime, we either have an issue in the sales process or we have an issue in the production process that needs to be addressed.
Oh, wow. I mean, that's impressive for an accounting firm. I have some friends who are accountants, and you don't see them from January until, April 16th or whatever it is. And it's their wives joke that they're like, accountant widows or whatever.
Yeah. No, and I went through that working at other firms. And that was one of the things when I started my own practice. I was like, you know what? I can see why that happens. And there's a lot of broken pieces there. And so we've really pivoted the model of how we do things so that, I don't have to burn out, staff members or myself just trying to meet filing obligations.
Yep. And I imagine your team's not sitting there with calculator tape either, crunching these numbers.
No.
But like you said, do a few things very well. I think it's a great business model. Sometimes we, as entrepreneurs, we want to try to be everything to everyone and say yes to everything. But every yes we say is we're really saying no to something else. Yeah. And it's simplifying our business is sometimes the best decisions we can make to really grow it and scale it. So that's great. Any books you're reading now on the business or leadership side that you'd recommend?
I've been reading The Slight Edge, and I've really liked that one. I'm not too far into it, so don't give me any spoilers if you've already.
Okay, I have not. What's it about?
It's basically about that most development, it's really on the margins of things is where you're making big improvements. So if you're really going to grow a business or grow yourself personally, it's really small improvements sustained over time is how you're going to see exponential growth and how you're going to have that continuous upward trajectory. So that's something that I've found to be very true, both, in personal life and also in business life. And then in a lot of ways, those go together. If you're not exponentially growing on, as a person outside of your business, like that lack of growth will leach into what's going on in the business for sure. Yeah.
I've heard it called like the 1% rule, where you just try to get 1% better per day. And then, that compounded over, any period of time becomes significant. So I think that's key. And it's the same for building wealth too. Every dollar that we can invest and compound, it grows versus we spend it on taxes or, things that don't earn us money. We're decreasing our wealth. And so it's a key, and it takes discipline too. It's not easy. Yeah. But that's great. I'll have to check that out. Slight Edge. Cool. So where can listeners connect, find out more about you, set up a call if they're interested in learning about these tax credits and any of that stuff?
Yeah. So I'm sure in the show notes will be a link to our website. Yep. I have a lot of resources and other podcasts and those sorts of things posted on there. I'm also fairly active on LinkedIn, so that's a good place to get connected. But through the website, I have, a lot more information on specifics of how some of these tax credits work for those that, want some nighttime listening materials. But I try to keep it interesting because I've found for most people, it's the stories around who qualify. It helps them see kind of what the opportunity there is for them, rather than dry, like this is how this calculation works. So that's a lot of what we have on the website to help guide people with what they might be eligible for.
That's awesome. Well, I appreciate you coming on today and sharing your wealth and knowledge. I think, you give people a lot of great things to think about, and hopefully go back and, find some money that's out there. So
yeah. Yep. Yeah. Awesome. I always joke with people, why work for the government for half the year when,
yep. You can only work for like a quarter,
changes and not have to
of the year.
Yeah.
That's awesome. Well, thanks again.
Thank you very much. It was so great to be here, Brian. Really appreciate it.